Hello. Welcome to the 39.6 Facebook Live show. This is episode number 52. Today is Wednesday, August 26th. We are doing this take two. All right. So, this is the 39.6 Facebook Live show, the show that teaches you how to make your money work for you so you don't have to work for your money. Talk investing, taxes, real estate, syndications, Airbnb, even the car you drive. Today's question comes from Ben. Can you please go over all of these abbreviations in multifamily investing? Today we're going to discuss net operating income and debt service coverage ratio. Okay, so NOI and DSCR, these are the two of the most important abbreviations to be familiar with when evaluating a deal. Okay, so I have this spreadsheet on Google Drive. I'm going to share this to the Facebook group, and I made this pretty simple. Please let me know if you can hear this. Make sure that the audio is coming through. That'll be fantastic. Okay, so this Excel spreadsheet or Google Drive Sheets spreadsheet is a very simple spreadsheet that doesn't have a whole bunch of line items. I made it really simple. For income, I just have two lines, rental income and other income. I set rental income at $100,000 and other income at $5,000. Other income is any income you earn outside of the rent of the unit. So that could be rent of a parking spot. It could be rent of a washer and dryer. It could be valet trash, all those other add-ons that you pay for. Okay, so that's your total income. Then we have your expenses. And I set this at $20,000 for property tax, $20,000 for repairs, $10,000 for property management, $5,000 for other, for a total of $55,000. These are just made up round numbers. Okay. Your total income here is $105,000 and your total expenses are $55,000. Okay. So I'm going to hide these rows to make it a little bit smaller and make it a little bit easier to see more things on the screen. Okay, so we have total income $105,000 and total expenses $55,000. Okay, and once you have those two numbers, all you need to do is subtract the two from each other, and you will get your net operating income of $50,000. Now, debt service is your mortgage payment, and here I have it listed as principal and interest. And it's very important that when you're looking at underwriting a deal, that you do not put your mortgage in the expenses from above. Okay, I just fixed that spelling. When you're doing your taxes, the mortgage interest is included in your total expenses, and that gives you your your taxable income. But when you're looking at net operating income or NOI, you do not include the mortgage in your expenses. Now, the debt service is your mortgage payment, principal and interest here, and we're saying that is $40,000. So our net operating income is all of the money that we have left over after paying the expenses, but before we have paid the mortgage. Then you pay your mortgage or your debt service of $40,000, and you look at that ratio, $50,000 divided by $40,000, and that is equal to 1.25. Okay, that is your DSCR. Now, I also have these abbreviations here for the mortgage. We often say principal and interest. We say P&I. And if it's interest only, we say IO. Often mortgages in multifamily are 1 to 4 years of interest only before converting to principal and interest. But this debt service coverage ratio is a very, very, very important number when evaluating the deal because it shows how cash flow positive the asset is. If your debt is equal to the net operating income, there is no money left. You pay your expenses, you pay your mortgage, and there's no money left for the owners of the asset to distribute. Okay. So you definitely need it to be higher. They're not going to give you a mortgage if the DSCR is equal to 1, or they won't give you a mortgage at that amount. So you want the number to be higher, like let's say 1.3 or higher. Okay. So if the expenses were lower, and let's say the property tax here was $15,000 instead of $20,000. Now your total expenses goes down to 50, and your net operating income goes up to 55. Your mortgage stays the same, but now that debt service coverage ratio, 55,000 divided by 40,000 is higher. It's 1.375. So that's how cash flow positive you are. You have 37.5% basically above the mortgage of extra money. So that is your cash flow. You'll have a cash flow of $15,000 if you subtract 55,000 minus 40,000. But here we're doing it in a ratio, in a proportion. Okay, so you definitely need to have the mortgage be only a percentage of your total net operating income to be comfortably cash flow positive. Okay, that is it for today for net operating income and debt service coverage ratio. Again, this episode is brought to you by the Medicine, Marriage, and Money podcast, coming at you in mid-September of this year. As our disclaimer, this show is only for your entertainment purposes, not to be construed as formal, legal, or financial advice. Please talk to your financial professionals before making any financial decisions. Until tomorrow for episode number 53, have a good day.